Hi, my name is Amy. Thank you very much for watching, and let's make some bad financial decisions together. This is for entertainment purposes only, so if you're entertained, please like and subscribe. I really appreciate that. So, yesterday in the wolf space, I actually asked two questions, and these questions felt better in my mind than what actually the question came out of my mouth. so, I wish I had asked it in a better way, but basically, my question was about the Target 25 ETFs. And my initial reaction to these ETFs when they announced it, and I just continue to have this burning question of, may I have your thought process behind arriving at a 25% distribution as a target? Because to me, it seems rather arbitrary that you're picking that. And maybe for those that are more in tune with doing their own options, maybe 25% yield is an intuitive, like a logical conclusion. But for someone like me that, I have done some of my own options and cover calls and doing the wheel, but I'm not an expert at doing options. I was just wondering, was there a scientific process they went by? Did they look at things? Like, what happened to get us at the target 25? And I will actually play their answer. Could you, the YieldMax team, would you walk through the process of coming to the conclusion that a target 25, how did you land at that number? Because to me, it seems a little arbitrary. To me, it would have been better to just do, because YieldMax is they want to return the implied volatility to the investors. So wouldn't it have been better to just do a percent off the IV instead of hard coding the 25%? Did that question make sense?
Michael Khouw, you're muted. There you go.
Okay, sure. Well, I see Josh is coming off, and Josh was around when these things were initially announced, so I'll let him speak to the thinking, and then I'm going to speak a little bit to the strategy and some of the math that's at work. So, Josh, you first.
Yeah, well, I just want to say I think that the 25% target is more of a simplistic way to explain to investors what they should expect from the fund. We could definitely do, like you're saying, a percentage of the IV of each different underlying stock that we launch a fund on. But we do also want to make our investment goals clear for our investors. And, when you have something like the percentage of IV, like you were saying, that's something that would change a lot over time. So we think, a consistent strategy where we're targeting a specified yield on an annualized basis is something that is easier to basically, know what to expect as an investor. So, the 25% target, it's not necessarily arbitrary, but it is, a middle ground, I would say, between what we've been seeing from some of our single stock long exposure funds and, the target 12 target, which we've gotten feedback from a lot of investors that's, not enough for them necessarily to be attracted to the product. So we thought that 25% is kind of that perfect middle ground. And it made sense because it was at least half the IV of many of our funds. I'd say that, around the average implied volatility for a lot of the stocks that we're trading for the single stock long exposure option income ETFs is around 50. So we thought making expectations more definable was more important than floating what that target rate would be. and it's meant to convey the implication that the funds would capture more upside minus that set expected amount of 25%. So that's kind of some of the thought process around the creation of those products.
Now, if I can just follow on a little bit with just some of the math. So let's just start with the target 12s as an example. So Biggie, which is, the large 50, the 50 largest companies, it's a target 12. Its total returns so far this year are about 16.86%. 5.75% of that came from capital appreciation. Now, the target 25s, when you're dealing with a single stock, so I'm not going to make this too wonky right now, but there is, if you think that the target 12 on something like Biggie is a decent way to think about a balance between capital appreciation and yield, which I think it is. That's actually revealed by the fact that I was trying to buy shares of it myself, but I'm apparently restricted for some reason this morning. When you look at single stock strategies where you're going to try to have a target return, why might something like 25 actually be kind of, we'll call it a thumb in the wind, but why might something like that be reasonable? Well, Biggie is a diversified fund. If you look at the volatility of a diversified fund, it is going to be approximately, so this is kind of a back of the napkin technique that many of you could use and some of you are probably already familiar with. The volatility of a basket of securities is going to be approximately the sum product, the weighted volatilities of all of its constituents times the square root of their respective pairwise correlation. So what that means is that if you think about what a single stock target yielding fund might look like, it's going to be some number that is the inverse of that, right? So, and I realize this is, it probably seems a little woolly. For those of you who want to learn more about this, by the way, JP Morgan wrote a great paper about this. It was back in 2006, if my memory serves me well. I've written a couple about it myself too. So we're looking for a balance of distributions and capital appreciation. Single stocks are generally going to exhibit, the opportunity in theory for higher distributions relative to a diversified portfolio like a Biggie would. And so, to me, if someone said, okay, well, you have to throw a number at it that gives people a sense of what they might expect, I think that's actually a pretty good one, just based on that math. Now, that's going to change a little bit because different stocks have different volatilities. But, if you're trying to give it some thought, and also remember, it's in the name. It's a target, right? It's an objective. And I think that doesn't necessarily mean that's where you land, just like the target 12s didn't necessarily land. Sometimes they can deviate materially. As we've seen, Biggie is pretty close. It's outperformed that, one could argue. If you look at something like Soxy, on the other hand, what was one's expectation for that, right? So I think it's probably a pretty good name, just understanding that we are dealing with the market and the vagaries of it. But I think it gives a pretty good sense, and there is kind of a mathematical basis to it too.
Okay. Yeah. Thank you.
One thing I just want to quickly add on to that. So one of the advantages of the 25% target, and really any kind of target yield for these products, is that all the single stocks we're going to be trading them on are going to have different implied volatilities, like you were saying, Amy. So, for example, we're going to be coming out with a fund on Tesla, and we're going to be coming out with a fund on Strategy Inc. Tesla's 30-day implied volatility right now is at 49.1. MSTR is at 70.5. So, we really want these funds to grow into the future from a net asset value perspective. And if we had a floating rate that was based on the implied volatility, we would see comparable performance to the single stock ETFs, where for this, we're trying to distribute that target yield, and then the rest of the upside potential in that fund, we want to go into the net asset value. So we're hoping that by offering a target yield, we'll be able to, basically allocate that extra that we are able to get from our option premium strategy into the net asset value for long-term growth.
Yeah, thank you for answering that question. I wasn't honestly keyed into it at first, but then now is probably a good time for the Mr. one to launch, because it's actually been beaten up so much that hopefully we get, it the price going up on Mr. itself. So in the middle of the second question that I asked, Michael Khouw actually found the white paper he was referencing, and we can forgive him for a little bit misremembering a little bit of the things, because it was a white paper that was written in 2004. So I definitely could not tell you anything about something that was published in 2004 that I read in 2004. That is not something I could do. So what I did was, because I don't actually want to ever listen to that ever again, I uploaded it into the Google Notebook, and I asked the AI to just give me the specifics from what he was talking about. And then I searched for the white paper using Google Notebook, and then I imported, because I'm pretty sure this is the white paper that Michael Khouw was referencing, and it's the fundamental relationship between an index's volatility and the correlation average volatility of its components. And if you think about it hard enough, it is pretty intuitive. And I've done this for you in the past when we're creating our own portfolios, where you take the implied volatility of each one and then you multiply it by the proportion it is in the portfolio, and then you add up all those numbers, and then that is pretty much the implied volatility of the entire portfolio, as long as the condition of them being properly correlated holds true. And so this is apparently, I also just asked the notebook because I'm not all that mathy. So I just wanted to make sure that I understood what I was reading in the white paper, which is what these LLMs are pretty good at, especially ones where you give it the context. So because a single stock does not actually have a correlation, because it's a correlation of one, because it's 100% correlated to itself, this particular formula is not applicable. So I think Michael Khouw and I could agree that some of this stuff is much easier to expound on if we have an example. So if we go to, I was looking this morning, the current price of MSTR is $223. The implied volatility, I thought that Josh said 75%, but the implied volatility is 70% right now. So basically, right now, Misty would go out and look for, on a Monday, when they do their trade for it, they would be looking for a premium of $3. That would get you that 70% yield. So when I looked at it this morning, and it's not, because today's Thursday, it's not exactly, but it's good enough for this example, okay? I found one at $240. The premium strike at that moment was $3.20. So that is 7.62% out of the money. And in their prospectus, they say they can go between 0 and 15% out of the money in their call. So that is a good medium, right? And then according to Robinhood, that has an 82% chance of it succeeding. So if we have a target of 25% on an annual yield basis, then the strike price would be, if it's based off of the premium, which is $1.07, we would be looking at the $255 strike price. The premium would actually be $1.03, which is 14.35% out of the money. And according to Robinhood, there's a 92% chance of this succeeding. Or like there's a 92% chance that at the current price of $223, it will not be above $255 by the end of when this call expires. So if I'm looking at strike prices, 10% of the money is going to be the $245 strike price. The premium would be $2, and it would have an 86% chance of us winning the bet. And 15% out of the money would be 92%. Then you have 20%, which is 96% out of the money, or 96% chance of winning. 25% is a 97% chance of winning. But when you go from 10%, which has a 42% yield, to a 15% with a 21% yield, or 20% out of the money with a 9% yield, these are all just what are you comfortable with, and like what percentage of guarantee do you want that you're going to win your bet? Like, what is the balance that we are looking for? So I suspected that when there is a lower implied volatility, because when there is the strike price and premium, or the premium does, the implied volatility factors into the price. So when the implied volatility is lower, then you have to go closer to the strike price to get a certain amount of. I've looked at the YieldMax website, and I just chose one that has around a 50% implied volatility. So this one is slightly above 55% yield. And this is Roblox. The current price is $101. So we're looking for a premium of $1.06. I found it at $108. The premium was $1. That was 6.93% out of the money. So that's basically within the 0 and 15% range that YieldMax has in their prospectus. And you have an 82% chance of winning. So if you go to the target 25, that means that we're looking for a premium of 48 cents. And I found that at the strike price of probably not 255, probably, okay, let me actually look. And this won't be, I did this before. So at 103, it was probably, so we're looking for a 48 cents. It was probably this 100. We'll just say we'll do it at 110. Sorry. Anyways, so it is 8.9% out of the money, and it has a 90% chance of us winning the bet. So 9 out of 10 times, this Roblox will not, if it's at $101, it will not go above $110. There's always that one chance that it does go above that. So I looked at this, and I did closer into the money because the implied volatility is lower and the price of Roblox is lower. So I would still do the 10% one. So, and get the 22% distribution and have an 87% chance of it succeeding. So as someone that's covering YieldMax ETFs, I definitely asked the question wrong, and I should have done this math and then gone with the questions. But instead of the target 25 and having to figure out how much out of the money that is, and then trying to figure out what's the closest strike and doing all that, I would rather what YieldMax have created like a tier 2 where they state in their prospectus they're going to be between like 10 and 20%, 10 and 25%, and they're going to target a delta of 1 or like just whatever is a delta of 1 or just slightly less. And it does mean that over time it'll fluctuate. You won't know that you're targeting 25%. It's not a certain yield percent that you are targeting. It's how much out of the money and what is the risk that we're in. Because if we can stick to around a 90% chance of winning versus an 80% chance of winning, I think a lot of people would say that is actually the maximum yield that you can reasonably get from these single stock tickers, because at a 90% win rate, you will win the cover call. And the other bet is with the synthetic part, it will go up in price, just not more than, 10, 15, 20% out of the money. So like it won't go up 20% or more in a single week is the bet. So all I'm saying is explaining that something's going to be 10 to 20% out of the money, targeting a delta of 1, is really not that much harder to communicate than targeting 25%. And if you did that, it would have the benefit of when the implied volatility does change over time, it will still make sense to have a target 25 fund. Over time, things like Misty, because Bitcoin, the implied volatility of Bitcoin over time will go down. So there's no guarantee that Mr. will always have such a high implied volatility. And as the implied volatility goes down, it becomes more risky to target a 25% number. And another benefit of doing in the prospectus, a 10 to 25% targeting a delta of 1 is that they can actually apply this to their entire line of products. So they could have, Misty, and they could have MSTB, which is just like the more out of the money version of this. And they could even have a 20% to 35% out of the money. And, if you're making a 10% yield on Mr. and you're getting the rest of it as price appreciation, then you could have these different levels, and it's because it's based off of real market conditions. I would have less concerns about how will this behave in certain market conditions, and would this be a long-term thing that's going to work in the long term. And so YieldMax has always been something that I've been curious, what is the maximum amount of yield that you can expect to get? And when I do my own options, I am generally the SoFi ones, I'm choosing the 94, 96, 98% chance that I'm winning. I'm really just not that aggressive. From my observation of covering this for a long time, this 80%, you are the 5% out of the money, it really does you lose the cover call bet. And because it's cash settled and YieldMax does not do the wheel, they have to pay a lot of money to close out of those contracts. And when it's going very well, the synthetic goes up enough that it kind of covers those costs. But what would happen if we have, like with these target 25 funds, where you win the cover call bet, so the call expires worthless, so they're closing it out at like 1 cent, 5 cent, and not like $2 per, contract, or $1 per contract, more than a penny per contract, and the synthetic goes up, and so the price of it does go up. I just think that maybe the target 25 is the correct answer, just with the wrong reasoning, if that makes sense. And I might be super wrong about this, and that 25%, if right off the top of your head that just makes sense and it's intuitive, then so be it. But to me, because everything is like it fluctuates, and so something that's more dynamic and we can make smart decisions and is less restrictive, to me, I just want to give YieldMax enough leeway to make their best decisions that benefit the investors. Because Tesla or Strategy, or let's just pick a new fund, no one ever talks about AMZY. Okay, it's based off of Amazon. If I wanted to do an Amazon silo, which I'm going to start to do, but it has a 37% distribution rate. So I'm going to assume that their implied volatility is in the 30s. And so in order to do the target 25, they would have to go kind of close to the money. And therefore, their chances of winning the bet goes down. And so the target 25 funds are only appropriate for certain parts of their lineup. And you might say, well, at 37% yield, you could just go with actual AMZ and get the maximum amount. But if you are concerned about the balance between income and the growth, wouldn't you want something that you could just apply to your entire lineup, no matter how low or high the implied volatility is? So, in conclusion, I'm not that angry at the target 25 ETFs. It's probably going to achieve what YieldMax is trying to answer from the community, which is these funds are all going down, and on the up days, they get capped, and so we're not getting as much price appreciation. And so the next time there's a downward movement on the stock, then we just have an outside, we're not recovering enough so that when there is the next down, we're okay. If you never recover from the stock going down and it goes down again, which these are single stock ETFs, they do have higher risks than a basket of funds, then there's going to be massive NAV erosion, and there's no two ways around that. So, do I think they're a good idea? Sure. Do I wish that they would have done it as just like a tier down of 10 to 20% out of the money, targeting a certain delta instead of the IV? Sure. That doesn't preclude them from doing it in the future, and I'm the only one talking about this right now, and I'm not that influential. I'm just saying that it would intrigue me more than a target fund from YieldMax, because there are competitors with these single stocks, and they have reasonable yields for the most part. So if I want a different yield, then I can go to their competitors. YieldMax is about finding what is the maximum yield that I can get from whatever they're doing. So over time, like with the target 12s, maybe when you have a basket of stocks, 12% is what we should be expecting from any kind of broad market index. I just wanted to clarify that I think that things that are fund of funds or on broad market indexes are probably more appropriate for a target fund. The reason for that is in the case of things like SPY and the NASDAQ 100, fund managers are able to do back testing to test what the target yield should be, and therefore it is up to them to target a responsible amount of yield that does not have NAV erosion and keeps enough breadth in the strike prices for us to get appreciation from those broad market ETFs or indexes. But in the case of things like SOXY, which are industry specific, since they can have the fund made up of whatever they want to, they can comprise the entire ETF of things that have enough implied volatility that they can responsibly put things out of the money enough that there's also price appreciation and you hit the yield target. So that was just one last parting thought for this, that for single stock ETFs, I would like more rules-based, based off of the actual market conditions, and for bigger things that have multiple components within it, or like multiple companies we're talking about, that target funds actually do make more sense. And so I would like to thank the members that I have: Eric, Russell, Paulette Pierre, Scott Behringer, Michael Holliday, Shane O'Mac, Bill Bryant, Patrick Spalding, BGP Automotive, in my opinion, Jetta, and Omega Werewolf X. You all are amazing, and thank you so much for making your bad financial decisions together with me, and you're helping me have this channel and YieldMight be something that I'm doing sustainably and as my full-time gig. So thank you so much. And today on Financial Philharmonics, we have Madness Undeniable, and it is about relying on the unreliable in the stock market. And so it's kind of a metal song, and I hope you all will enjoy it. And the question still is, what are your thoughts on these Target 25 ETFs? Are you interested in it as long as there is, a good track record? I mean, MSCR recovers and it's been doing well for a few months. Are you interested, or has the ship sailed for you for YieldMax? And I'll talk to you later. Bye.